I think we can get started. Thanks everyone for coming. This is an event to discuss the new Saez and Zucman book on taxes, which will be available for sale afterwards. And you should all at least consider buying it. So we're going to have Gabriel talk for 30 minutes about the book and the arguments in it, and then we're going to have a lengthy discussion by Professor Kopczuk, and then we'll open it up for questions. Okay, without any more ado, Gabriel, take it away.
All right. Okay, thank you. Thank you so much for being here. It's a great pleasure to present this book. So what we're trying to do is three things. One is that we construct new statistics of how much each group of the population in the US has paid in taxes, going all the way back to 1913 up until 2018, which is the first year after the Trump tax reform. Second is we try to propose some elements for a new 21st century tax system that would reconcile globalization with progressive taxation. So many people have a view that, you know, in a globalized world, you can't really tax corporations or the wealthy. They will move abroad, they will hide assets, they will shift profits to tax havens, and therefore we should just stop doing that. Stop taxing income and tax consumption instead. And, you know, why not? We think there is a big problem, you know, down the road because consumption taxes are regressive, and so if globalization means ever lower taxes for those who benefit the most from it, you know, the shareholders of multinational companies, and at the same time higher taxes for those who don't benefit a lot from it or sometimes suffer from it, you know, retirees or small business owners or low-wage workers, then it's not sustainable, you know, neither politically nor economically. But our point is, look, you know, it's completely wrong to think that these two things, globalization and tax progressivity and income taxation, are incompatible. They are, in fact, perfectly compatible. And the third thing, and perhaps the most important one, is we've developed this website, taxjusticenow.org, where people can simulate their own tax reform. So starting from the current tax system, what happens if the US introduced a wealth tax? I can change the rate, I can make some assumptions about how much evasion there would be. You know, people have different views about that. What about if the corporate income tax rate was increased, or if VAT was introduced? How would this change the overall progressivity of the tax system, and how much revenue would this generate? So a very, you know, kind of user-friendly tool for the public, because, you know, it's not for economists to say what taxes should be. It's for the people to decide through democratic deliberation and the vote. And where economists can be useful is by making more concrete the various alternatives that exist and what would be their implications for society. So that's what we try to do with the website. The book has three parts. First part, which is the one that so far has generated the most debate, but hopefully the other parts will also generate some debates. The first part, which is the first chapter, is how much taxes the various groups of the population pay today in the US. Chapters 2 to 5, second part, is about history. It's about how the US moved from having one of the most progressive tax systems in the world to a tax system which today is essentially a giant flat tax. So telling this story, you know, telling the story of the New Deal era tax system and how it was undermined, and it's a story, you know, about changing norms, about culture, about politics, as much as it is about economics proper. And then the last part is our proposed tax reform, which obviously is just one among you know, an infinity of possible reforms, and trying to explain it. And all the data, the code, the programs, the technical appendices, everything is online and on this website, taxjusticenow.org. Okay, so let me start with just what has happened to inequality in the US. So that's income inequality. That's the best estimate we have about what has happened to the distribution of pre-tax national income in the US. The top 1% share of pre-tax national income used to be around 10, 12%. In 1980, now it's about 20%, so it has almost doubled. And exactly the opposite process has happened for the bottom 50%. They used to earn about 20% of total income around 1980. Now they earn about 10, 12% of total pre-tax national income. So what the 1% has gained, relatively, is about as much as what the bottom 50%, a group that's 50 times larger, has lost since 1980. Okay, so the tax system plays an important role in regulating inequality. Many other policies matter, but the tax system is an important tool. And so the question is, okay, what does the tax system do today? Now, what we do in chapter 1 of the book is we take 100% of the official amount of tax revenue in the US, federal plus state plus local taxes. You add up everything, that's 28% of national income, and we distribute that total across the different groups of the population. And what we find is that contrary to a widely held view, the US tax system today is not progressive. I mean, it's barely progressive. I'm going to show you the graph up to the upper middle class, and then it becomes somewhat regressive at the very top end. And in particular, what we find is that billionaires today, the top 400 wealthiest Americans, pay a lower tax rate than the bottom 50%, the working class or the middle class. When you take into account all taxes, the top 400 tax rate is 23% in 2018 versus about 25-30% for the middle class. So that's the graph. So to be very clear, on the x-axis, you have bins of pre-tax income. Pre-tax income is income before government intervention, but after the operation of the pension system and the social security system broadly defined. So it includes all retirement income, it includes social security benefits, it includes unemployment insurance, it includes disability insurance benefits, but it excludes other government transfers like food stamps or temporary assistance. So we rank people by their pre-tax income. P0, P10 is the 10% with the lowest pre-tax income, and we zoom at the top, within the top 1%. It's important to zoom at the top because the top 1%, as I said, earns 20% of total income. If the tax system was progressive, it would pay more than 20% of total taxes. If it was very progressive, it could pay much more than 20%. And so you want to know what happens within the top 1%. We go all the way up to the top 400. Why do we care about the top 400? You have a number of candidates like Bernie Sanders or Elizabeth Warren who have tax plans that specifically would affect the top 400, with wealth tax rates that are higher for billionaires, and so it's legitimate to try to know what they pay today and how they would be affected by such reforms. And then on the y-axis, you have just their effective tax rate, so total taxes paid divided by their pre-tax income, as I just defined it. For the US as a whole, as I said, it's 28%. That's the official tax to national income ratio. For the working class, around 25%, 26, 27, rising to a bit more than 30% for the upper middle class and the bottom of the top 1%, then falling to 23% for the top 400. Why is it the case that the poor pay a lot in taxes in the US? The US doesn't have a VAT, but it has what you could call a poor man's VAT. So lots of sales taxes, excise taxes, other indirect taxes like motor vehicle licenses, which the difference with the VAT is that all these sales taxes exempt services. Need a lawyer? No sales tax. Country club membership? No sales tax. But if you buy food or cars or appliances, you pay sales taxes. Many states have lower rates for groceries, but they also have very regressive excise taxes on federal excise tax on gas, but also on tobacco and alcohol and so on. So that's reason number one. Reason number two is the big increase in payroll taxes, which used to be small in the 1950s, 60s, and now today it's more than 15%. So you're a wage earner, from the first dollar of wage earned, 15% goes to the IRS. And so here it's striking to contrast the US evolution with the European evolution. So in the US, as I'm sure many of you know, the federal minimum wage has declined enormously since the late 60s, early 70s. Now today it's $7.25 an hour. And at the same time, payroll taxes have increased a lot. European countries have done just the opposite. They've increased the minimum wage. Even some countries introduced the minimum wage, like Germany, like the UK, at the same time cutting payroll taxes for low-wage workers. So the US did the opposite. Why do the rich pay relatively little? It's essentially because capital income is becoming almost tax-free. So if you are a big shareholder of a corporation and the corporation doesn't pay dividends, you pay essentially now very little in taxes. The only tax that you pay is the corporate tax. It's your share of the corporate tax, but the corporate tax now has almost disappeared in the US, collects 1% of national income against 5% a few decades ago. And if you earn dividends, then you get reduced rates. The US tax system has a lower rate for dividends as opposed to wage income. So one striking example is, let me explain it what I described this graph, which is just the first graph, but just showing the tax rate by type of tax. So to understand why for the top 400 individual income taxes paid are low, think about Warren Buffett. Warren Buffett is worth about $80 billion, according to Forbes magazine. What his true economic income is his share of Berkshire Hathaway's profits. He's one of the main shareholders of Berkshire Hathaway. Let's say he owns, let's say he has a 6% rate of return on his wealth, and so his true economic income is 6% of 80 billion, is around $5 billion. That's his share of Berkshire Hathaway's profits. He instructs Berkshire Hathaway not to pay dividends, and so the only income that he realizes and that he is taxed is when he sells a few shares. So he sells a few shares every year, realizes 10, 20 million in capital gains, and pay capital gains taxes on that. So if he realizes 10 million in capital gains, he pays 3 million in taxes. And so his effective tax rate is 3 million divided by his true economic income of 5 billion, which is 0%. And you might say, oh, let's fix that by just increasing the top marginal income tax rate. Yeah, go for it. Increase it to 100%. He will pay 10 million divided by 5 billion, which is still 0%. So that's not going to make a lot of a difference. So that's the reason why the wealthy, and they're not all the same. Some in the top 400 pay high tax rates because their businesses are organized as pass-through businesses. Others have, like Buffett, like Zuckerberg, like Bezos, like other billionaires like that who are shareholders in big listed companies, have tax rates which are very low. All right. What about the long-run changes in tax progressivity? So that's a graph that shows just the first graph. The second graph I showed, tax rates by income group for 2018, but now adding the same curve for previous years. And what you can see is that over time, there's a lot of action within the top 1%. So in the 50s, 60s, 70s, the very wealthiest and highest earners in the US paid 50, 60, 70% of their income in taxes. And it's really, in 2018 for the first year that the very top pays less than the middle class and the working class. So dramatic changes in tax progressivity. And these are effective tax rates, right? These are not statutory tax rates. These are tax rates that, again, same methodology, take into account all taxes paid at all levels of government. So how can we explain this evolution? Three main drivers. One is the collapse in capital taxation, itself essentially reflecting changes in politics and ideology. The second is the choice to tolerate certain forms of tax evasion. So that's the story we tell in chapter 3 and 4 in the book. When you look at the episodes of retreat of progressive taxation, you always have the same pattern. You first have an outburst of tax avoidance, And then basically governments saying, oh, look, there's tax avoidance, we can't tax the rich or multinationals anymore, and so we have to slash their tax rates. And that's pretty much what happened in 1986 with the Big Tax Reform Act. So what we found is that tax avoidance increased enormously in the first half of the 1980s. There was this huge tax sheltering, people using partnerships to shelter income, loss-making partnerships to shelter income, which escalated, after Reagan entered the White House in 1981. And then in 1986, you have this big bipartisan tax reform where 97 senators out of 100, including Ted Kennedy, Al Gore, Joe Biden, all of a sudden say, oh, we should slash the top rate to 28%, the top marginal income tax rate, which is a fascinating, if you want, historical development, because I'm going to get back to that. The US used to have 90% top marginal income tax rates. Even when Reagan entered the White House, the top marginal income tax rate was 70%. In just a few years, the very country that invented the quasi-confiscatory top marginal income tax rates, in just a few years, almost everybody thinks that, oh no, 90%, 70%, we should do 28%, which at the time was the lowest tax rate among industrialized countries. Another illustration is what has happened to the corporate tax in the December 2017 tax reform. So a lot of corporate tax avoidance over the last couple of decades, massive profit shifting to tax havens, more or less everybody, agreeing, both Democrats and Republicans, that look, other countries have low rates, we should cut our rates, the corporate tax is broken, there is all this tax dodging, there's no choice. And, Obama himself had advocated for a lower corporate tax rate in office of 27%, 25% for the manufacturing sector. And so in contrast to the Tax Reform Act of '86, in 2017, the Democrats did not vote in favor of that tax reform, but the similarity is that they also agreed, most of them, on the idea that the corporate tax should be slashed. Third driver is the current form of globalization, which is characterized by basically tax competition and a great deal of financial opacity. And what we explain in the book is, look, this is only one possible form of globalization. There are many other potential forms of globalization. Tax competition is a choice. We can make other choices. We can choose tax coordination. Allowing profit shifting is a choice. We can make other choices, as I'm going to explain in a second. The corporate tax plays an important role in our story because it has changed a lot over time. So that's something which is very basic, which I actually discovered by working on this book, which is that at some point in the early 50s, the corporate income tax, the federal corporate tax, collected as much revenue in the US as the federal individual income tax, at some point as much as 7%. Then what has happened is that individual income tax revenue have stagnated essentially, while the corporate tax has declined from its peak of 7% to just 1% today. So it's pretty fascinating here. You see the death of a tax which used to be really important. And there are many reasons why it has disappeared. Many factors have contributed to its decline. One important factor is this picture here that shows the gigantic rise of profit shifting to tax havens by US firms. So this is the fraction of their foreign earnings that US multinationals book in tax havens. And it was less than 10% in the late 1960s. Today it's about 55%. 55% of all the profits made by US companies outside of the US are booked in Ireland, Switzerland, Caribbean tax havens, Singapore, Netherlands, Luxembourg, and Puerto Rico, where they are taxed at rate in between 0 and 5% typically. The corporate tax plays an important role because you should think of the corporate tax essentially as a de facto minimum tax on the very rich. The very rich, most of their wealth is invested in equities, and the corporate tax makes sure that they pay taxes whether the corporations pay dividends or not, because you have to pay the corporate tax whether you distribute dividends or not. And it turns out that in the 50s, 60s, when equity ownership was very concentrated, the corporate tax was very high.
the effective corporate tax rate was almost 50%. Means if you are a shareholder, even if your company, even if you instructed your company like Warren Buffett not to pay dividends, half of the profits would immediately be paid in taxes to the government. And that's actually what's driving most of the change in the effective tax rate of the top 0.1%. It was 55, 60% in the middle of the 20th century under Eisenhower, Truman, and so on. And it was not because of the individual income tax. It was essentially because of this big de facto minimum tax under which the corporate income tax. All right, so now I'd like to discuss some elements for reform. So our reform has three aspects. As I said, reconcile globalization with tax justice with a plan to stop corporate tax evasion and tax competition. Second is protect democracy by taxing extreme wealth. So I'm going to talk about wealth taxation. The third aspect is how to fund the social state, the incomplete US social state, and in particular healthcare, through income taxation. So obviously, this is one, among many possible sets of solutions, and I encourage you to simulate your own tax reform online. So let me start with globalization and how to fix the corporate tax. So many people think that it's impossible to tax corporations in a globalized world. They'll move abroad, they'll shift profits. Now, this is wrong. I'm going to demonstrate that there is a very simple policy solution to that problem, which is very simple. You take any company, you can compute the tax deficit, what we call the tax deficit of any corporation, defined as the extra tax that this company would have to pay if it was subject to a minimum effective corporate tax rate in each of the countries where it operates. So this computation, the IRS can make it for any corporation, for US corporations, for foreign corporations. What's your tax deficit? And then for US corporations headquartered in the US, what we are saying is the US should collect 100% of the tax deficit. So concretely, if Apple books profits in Ireland taxed at 1%, and the benchmark minimum tax rate is 25%, then the US should collect the missing 24%. End of story. For foreign corporations, the US, any country that wishes to do so, should act as tax collector of last resort, which means, okay, you have a tax deficit. Some countries choose not to tax you, but let's say you made 20% of your sales in the US. We, the US, are going to collect 20% of your tax deficit. And you see like that how you transform, first of all, you see that all countries actually have an incentive to collect this tax deficit. Not doing it means leaving money on the table. So if the US did it, my guess is that European countries would quickly follow suit. And second, you see how quickly you can transform globalization from the current race to the bottom, where all countries are slashing their rates one after another, to a race to the top, where countries start collecting the tax deficit and the effective tax rate increases. And instead of competing with low rates to attract firms, countries would compete with the best by providing the best infrastructure, the most productive workforce, the best markets, and so you change completely globalization like that, from the race to the bottom to the race to the top. Wealth taxation, you might not know this, but the US actually invented wealth taxation. In the 17th century, a number of US states had wealth taxes, not only on real estate and land, there's a very long history of property taxation, but also on financial assets, on cash, on bonds, on stocks, everything. And in fact, and that's again a story we tell in this big part 2 of the book about the history of taxes. The fight over wealth taxation is a central fight, in the history of taxes in the US. You take a state like Massachusetts, before 1915, it had a wealth tax on real estate and financial assets, which kept being attacked by Harvard professors in particular, who said, "Oh, look, European countries, they don't tax financial assets; they have just property taxes, excluding financial assets. So you should get rid of it. We should do like the Europeans." And finally, they prevailed. The Massachusetts wealth tax was abolished in 1915. We're very much having the same debate, I think, today. You have these two traditions, more broadly speaking, in U.S. tax history. There is a progressive, very progressive tax tradition that I'm going to discuss in a second. And there is also an anti-tax, anti-government, anti-democracy tradition that's largely rooted in slavery. So if you contrast the tax system of Massachusetts in the 18th century to the tax system of Virginia, what you had in Virginia was essentially the opposite. No income taxation, no wealth taxation, and the slave owners fought to make sure that no property tax would ever be implemented, because their main fear was that people and governments would use property taxes as a way to abolish slavery, in a period when slaves were considered property. And so they created, in fact, the rhetoric that is so pervasive still today, about the evil of income and wealth taxation, about the evil of government intervention, and so on and so on. The progressive tradition is well summarized, I think, by the very famous speech that Franklin Roosevelt gave in Congress in 1943, where he goes to Congress and he says, "Look, I think that nobody should have an income after paying taxes of more than $25,000. Therefore, I propose a 100% top marginal income tax rate on all sources of income, including income from tax-exempt securities, everything. 100% top marginal income tax rate above $25,000, the equivalent of several millions today." And Congress hesitates a little bit. 100%, maybe it's a lot, but they agree on 93%. 93% is not very different from 100%, and for a long time, they had 90%, more than 90% top marginal income tax rate, close to 80% top estate tax rate, 50% corporate tax rate. And this is a US invention. No continental European country ever had such high top marginal income tax rate. The US was the democratic country that came the closest to imposing a legal maximum income. And the reason for this, it corresponds to something that's deeply rooted in American society. The US, for a very long time, used to think of itself in reaction against the highly aristocratic and unequal European societies, from the revolution to basically to the 1980s, or at least to the 1980s, or to the middle of the 20th century. Europe was seen as the anti-model, an oligarchic anti-model, too unequal, not progressive enough. So that's the other part of the US tradition. Let me talk quickly, because I only have 1 minute, but I'm almost done, about wealth taxation with just a little graph. Wealth concentration has increased a lot. The top curve is the share of wealth, of US wealth, owned by the Forbes 400 richest Americans. They used to have 1% of US wealth in 1982. Now they have about 3.5% of US wealth. And here the graph shows how this would have evolved if there had been a Warren-type wealth tax, which is 3% on wealth above 1 billion. You see that even with a 3% wealth tax, their share of wealth would have still increased very substantially. That tells you something about how big the increase in wealth concentration has been at the top. 10% wealth tax is what you need to kind of stabilize the share of wealth owned by billionaires at their 1982 level. And so in the book, we discussed that option. Then Piketty has a new book where he says, no, look, you're all too moderate, you're sellouts. It should be 90%. 90% top marginal tax rate on wealth above 1 billion, which is basically this idea of, abolish billionaires. I'm not going to have the time, unfortunately, to talk about healthcare, which is very important, nor will I have the time to talk about consumption taxes, but this is just one illustration of the reform we propose. The black line is the the current tax system when you include mandatory health insurance premiums as taxes, which I think is the right way to do if you want to think about tax reform and the transition to Medicare for all. And the red line is our proposed tax reform, basically. All right, let me conclude. The main point is the widely held view that technical or external constraints make tax progressivity impossible, in our view, is wrong. There's technically nothing in globalization that prevents progressive taxation. Tolerating tax avoidance, tax evasion, these are choices that governments make. Sometimes they facilitate this, sometimes they don't. There's an infinity of possible future policy paths, and where economists can be useful, I think, is in two ways. One is showing the multiplicity of these possible futures, and the second one, and I'm going to borrow that from Esther Duflo, who just won the Nobel Prize. She has this wonderful article titled "The Economist as a Plumber," where she said, we should be more like plumbers, and look, it works very well for taxes. I very much agree with that. You have leaks in the tax system, things that don't work well. If there is a demand, a democratic demand for progressive taxation, we economists can help make that happen and make taxes work. Thank you very much.
We'll now hear from Professor Kopczuk.
What do I do to get my slide? Okay, that's the screen. Yeah. Okay. Yeah. All right. As some of you may know, I've been critical of some things that Gabriel said, and there are points of agreement, but I guess we'll come back to them during the discussion when that's relevant, and I'm mostly going to be complaining. That's also my nature. All right, so point one, or the thing that I'll spend most time on is data. And to what extent what we've seen can be interpreted as facts, and to what extent there are problems in the numbers that you've seen. So the key to all of this is measuring progressivity. So how do you measure progressivity, and what do they do, and what everybody else does? So you have to pick groups, and for those groups you want to calculate the average tax rate, and that means you have to calculate something that's taxes, put that in the numerator, and divide it by income. So what can go wrong with a calculation like this? So first group, we can consider different groups, and we can define groups in different ways. We can think about individuals, households, tax units. We can split population in various ways. We have to sum the taxes, but to sum, we have to decide what it is that we are actually summing. There are actually decisions to be made, and I'll come back to that. We actually have to measure taxes, and that's also non-trivial in this context. So for some taxes, that may be relatively straightforward. Like, when you think about income tax, you look at what's on the income tax return. For corporate tax, that gets harder. For sales taxes, it gets harder, and so on. And the same thing in the numerator. You have to sum incomes, you have to decide what incomes you count, and you have to measure those incomes. And then you can get these numbers, and you can do it in a lot of different ways, and ideally you also have an answer to the question, why are you doing all of this for? What's the interpretation of the numbers that you get? All right, to set the stage, I'll show first a few figures, and then I'll talk about particular issues in how these things are constructed. So first on income, if you think about measurement of income inequality, Gabriel showed some figures on that based on their own research. There are other papers that look at this thing and come to somewhat different conclusions. So probably the best known nowadays paper on this is a paper by Otten and Splinter. I showed you both the series from both of these, from their paper and from Otten and Splinter. You can see that the levels are different, and actually the dynamics, the slope of these lines in recent years is different. Now, Why is it the case? That's a long list of differences. So I'm not going to go over all of them. They all matter to some extent. And all of them are about things that we really don't know precisely. So what are the types of things that we don't know precisely? The exercise here is to allocate national income to somebody. And there are types of income that are observed on tax returns, and there are types of income that are observed in some surveys, and there are types of incomes that are very difficult to know. And even if they are observed in surveys, linking and matching that to tax returns is complicated, and so on. So there are decisions to be made. So there are one thing to keep in mind is that there are tons of assumptions, imputations that go into these calculations. So some of these assumptions, like the most important one, or quantitatively the most important one that mattered in Otten and Splinter, doesn't explain majority of the difference, but just like you look at how it played out, was allocating tax evasion. The first time I saw it, I couldn't believe that that's actually something that may matter. But it turns out that the issue there is whether you assign tax evasion. We know that there is a lot of tax evasion out there. Whether you assign it to people that already are observed to have high income, or are you assigning it to people who are low in the distribution, sometimes with negative income? So small business owners, for example. That assignment actually turns out to make a lot of difference. There are things that are related to retirement accounts. There are a lot of retirement accounts. There's a lot of money sitting there. There is income that accrues to retirement accounts. Who owns them? I mean, if you had perfect data, you would know who owns them. But we don't have perfect data, and matching that to the position in the distribution is complicated. So I'm not taking this as saying that Otten and Splinter are right on every decision that they've made, but that sort of shows you the margin of error that you can have in all of this. So at the very least, like whenever I see these types of figures, I would like to see something like confidence bands, standard errors around these things, because these are not exactly facts. There is data behind them, but there are so many assumptions that are based on very, very imperfect information that when you aggregate that, you are really quite uncertain. So that's on the income side. All right, so on progressivity side, so I'll start by comparing measures of progressivity from two different sources that are basically by the same authors. So one is a paper that was just published in the Quarterly Journal of Economics last year by Piketty, Saez and Zucman. The other one is the book that Gabriel was showing numbers from. So this is the comparison for 1962. It's kind of a little bit differently displayed than what Gabriel was showing, because the lowest group is just the bottom 50%. Other than this, it's the same. So in 62, according to their book, the tax rate at the top of the distribution was higher than according to their article. You flip to 2014, that relationship flips. So if you sort of compare those two things, you look at the red line, it shows a big drop. You look at the blue line, it doesn't really show much of a change. So that's the difference between article and the book. So I'll explain where it's coming from. You can sort of look just at the top rate. So this is the tax rate for the top 0.01%. And the red line is the evolution of the top rate according to the numbers in the book. And the blue one is the evolution of that top 0.01% rate according to the numbers that are in the article. They are, you can look at this figure, and they are not the same. The slope is different. And it actually turns out, like if you sort of look at the magnitude of the changes, it's actually dramatically different. It's 18% percentage points drop according to the book, and 4 percentage drop according to the article. Now, this is based on the same data. So this is so the only difference between those two things. I'm showing 2014. I'm not showing 2018 or anything like this. The only difference between those two things is how you calculated the average tax rates, assumptions that went into this, and they sort of changed. I mean, they are explicit in the book and appendices how they change them, but that sort of that shows how much room you have to actually modify the picture of this of what's been going on. All right, so this is these are progressivity series progressivity series from this article by Otten and Splinter that I showed you. So the red line is a measure of progressivity of the U.S. tax system according to Otten and Splinter, and the blue line is the measure according to Piketty, Saez, Zucman, the article from a year ago, and then sort of you move to the right, and that's so this one is 2014. That's where everybody has the data. The one on the right is 2018. There is actually, I'll come back to it, there's a lot of guesswork that's about 2018, because even tax returns have not yet been filed, or now they've been filed a few days ago. But that data is not even there. So we can also see sort of quite dramatic differences. Now, where do those differences come from? Part of it is measurement of inequality. Part of it is different assumptions, how to calculate these things. This is from CBO, Congressional Budget Office, impartial, non-partisan agency that also engages in this type of exercises. So this is a measure of the average tax rate. This one is based on households, not on individuals. That's one difference. This one is incorporating state and local taxes. There are some other differences, but it's also not showing the decline, the regressivity that you've seen. This is a CBO accounting for transfers, so progressivity of the overall tax system. So you basically you want to flip it to think about how it corresponds to the previous one. So taxes at the top. Once you add up the transfers, the system is quite progressive. Right, so there are a lot of different, there are a lot of other things that you could look at. So let me explain some of the things that are behind it. And there was a lot of discussion on social media about that, and people coming on both sides of it. So you can sort of read the comment by Paul Krugman, who was looking at these numbers, and he sort of acknowledged that there are a lot of judgment calls that you have to make in this context. He wasn't particularly bothered about consequences of it. I'm more bothered, but this is kind of to illustrate that the sort of uneasiness with how these numbers were constructed is not just related to just being, you know, critical of anything about inequality. There are sort of two general measurement principles that are behind what they are doing in the book. So one is that they want to allocate all of the national accounts, and they want to allocate taxes consistently with national accounts. So no double counting. If you include taxes, then you are not going to include transfers that they pay for example. The other one is heavy reliance on statutory rather than economic incidence of taxes. So I'll come back to that. All right, so let's start at the bottom. All right, so I've already talked about the income measurement issues, so I'm not going to come back to that. Now there's the question of adding up income. All right, so there is a decision to be made. So this is all pre-tax, pre-transfer income. Right, so that's important, but not inconsequential. So pre-transfer means somebody gets welfare benefits, that's not counted. Somebody gets SSI, that's not counted. Social security is included. That's one exception. That also has consequences for what you do on the payroll tax side. But there are a lot of payments that are sort of relevant for thinking about well-being of the population at the bottom of the distribution that are not part of the denominator. Okay, so that's one. Two, and that's kind of smaller, but kind of surprised me. There is negative interest income at the bottom of the distribution discounted. So people pay. people may have student loans, mortgages, consumer debt, and so on. Like, do you think about it as negative income, or do you think about it in some other way? If you are thinking about payment on student loans as negative income, are you thinking about loans when you receive them as positive income? Well, it's counted as negative income. It's not, as far as I understand, it's not counted as positive income. So there are issues that are happening there. Sum of taxes. Okay, so this is supposed to be taxes, no transfers, no refundable credits. That's actually something that's kind of blurring the line, because things like earned income tax credit, that's up to $6,000 per person, that's operating through the tax code. Many people think about it as negative tax liability. Actually, it's designed to offset payroll taxes. So if you looked at it as kind of just total tax system, it should be counted as a tax. They exclude it. They are not the only ones to exclude it, but that has consequences. So then you're adding up taxes, and here, okay, so there is a question of how to allocate taxes to individuals. So for some of them, it's relatively straightforward. For others, it's not. So when you think about sales excise taxes, they are based on consumption. So now we have a problem, because if you are looking at taxes, sales taxes are partially based on consumption. So if you are looking at them based on consumption, but you don't account for income that comes from transfers, then you are going to have people that have consumption but have no income. So they will have tax liability but no income. So they will look like they have very, very high tax rates. So that's actually part of what's happening at the bottom of the distribution. In particular, for the numbers that they are showing as the bottom 10% of the distribution, you have sales excise taxes as high as 10%. I tried to figure out how is that, like, is it really possible that somebody will get there? So states have sales taxes of the order of 6-7%. There are some states that have higher taxes, some states that don't have taxes. So let's say 6-7%. That's not on all of consumption. Gabriel highlighted that there is a lot of consumption at the top of the distribution that escapes it, but there is a lot of consumption at the bottom that escapes it. So for example, food escapes it, rent escapes it. Like big things, like non-trivial things that escape it. So we are not going to get to 10% through sales taxes. You are not going to get to 6% through sales taxes. Now, are there things that are sort of taxed at rates that are higher than 10%? Yes, there are. There is gasoline, fuel, there is tobacco, there is alcohol. But you would have to be spending all of your money on gasoline, tobacco, and alcohol to get to that. I think what's driven by is that income is just too low from the point of view of thinking about an economically meaningful measure of how it reflects well-being. As an aside, for the corporate tax, they insist that you should rely on statutory incidence of the corporate tax, but that rule is broken here. So if you look at sales taxes, well, statutory incidence of sales tax is on sellers. It's not on buyers. Now, I'm completely fine with assuming that there is a pass-through of sales tax, but that's an assumption. That's an economic assumption. Now we are not relying on statutory incidence. Now we put economic assumptions into the calculation. For the payroll tax, part of the payroll tax is responsibility of employer. Part of it is a responsibility of employee. They put it on they put it on the employee side. I'm not terribly troubled by that, but again, this is an economic assumption, and actually, Emmanuel has a paper that shows that that assumption fails in Greece. So, there is a lot of assumptions that are made here that sort of are inconsistently applied. All right. So then, what do you do with this next? So now you have the situation where when you look at the very bottom of the distribution, there are taxes paid, but there is no income. That results in extremely high tax rates. So they solve the problem. The way they solve the problem is by dropping people with very low incomes. Now, that's not really a solution. That's kind of that's acknowledging that the measure didn't make sense to begin with, or it wasn't measuring anything that that you were looking for. So that's so the population for which tax rates are based on is not everyone. It excludes people with very low incomes. All right. So that's 27 million people that got dropped. That's not a small number of people. Now, then you can also start thinking about what is the bottom of the distribution. So this is sort of ageless population without any defining characteristics. Well, people at the bottom of the distribution that have a low income, when we are looking at individuals who are 20 and older, are college students, retirees, institutionalized population. That's part of that group. Now, there are some transfers that are happening even past the 27 million that they are talking about. There are demographic changes. You have more college students. You have more retirees. That's sort of moving the bottom of the distribution and changing how many people have very little income. There is also a problem here with economies of scale. So once you are assigning everything to individuals, it matters whether you're looking at individuals or households. $18,000, which is their median for the bottom 50%. For two people, well, first of all, $18,000 is already above the poverty line as defined by census. For two people, it's $36,000. I'm not saying that that's a lot of income, but that's now you can start to understand how people can actually live on that amount of money, especially in some places, maybe not in New York. So that's the bottom. For the top, what happens there? So this is, I'll just illustrate it by comparing the two series from their book and from the paper to show what changed and what matters.
10.
10? Oh, that's a lot. So the first thing that the big thing, the most important thing, is changing how the corporate tax is allocated. Right? So if you just change the allocation of, so again, the blue line is sort of their previous series, the red one is what's in the book. So if you just undo the allocation of, or if you apply the allocation from the book to what they had in the paper, that's how the blue line would look like. So now they are basically parallel. So so we basically recovered most of it, and then there are sort of two other changes that happened. One is they changed the assumptions or how they calculate the burden of the sales tax, and there is something about the income tax that I don't fully understand. But they these are basically constant changes over time. So the big one is the change in the corporate in corporate tax incidence. All right. So no, sorry, I'll skip this one. All right, so, no, okay, this is the one I wanted to talk about. Okay, so measurement at the top. So the big one is corporate tax incidence. All right, so there are a number of questions about corporate tax incidence that are that you can think of. So, so first of all, what is it about? There is a tax that's imposed on corporations. Right? Who pays that tax? Right, so a statutory incidence assumption that they want to make is that the tax is paid by shareholders of the corporations. That's not the typical economic assumption that's made in this context. So I'm not going to necessarily claim that the typical economic assumption is right. I'm very open to discussing and kind of evidence on questioning that economic assumption. But the economic assumption, the assumption that everybody else does it everywhere, like or almost everywhere, or at least the things that I know of. The assumption is that there is a tax on corporations, and then things adjust. All right? So what adjusts? One thing that's very familiar, and that was part of the debate about the corporate tax change 2 years ago, is what are the consequences for wages? If you are going to tax, reduce corporate taxes, is any of that going to show up as higher wages? All right. So if that was the case, then part of the incidence of the economic incidence of the corporate tax would be on labor. Right? So in neither the paper nor the book, they assume any incidence on wages. Now, that's a strong assumption. Many people would disagree with it, and probably would disagree with it, but it's kind of within the realm of the sort of usual set of assumptions. There are very recent good papers that show that that there is a change in that there is some incidence on wages that would point in a different direction, but that's not a crazy assumption. So the less familiar one, and the one that matters here, is that the usual assumption, going back to Harberger, is that when you tax corporations, capital flows from corporations into other firms. What are the other firms? Well, non-corporate firms. What could it be? It could be housing. Maybe that's not very realistic. It could be non-corporate businesses, pass-through businesses that are a very big deal right now. That's probably more realistic, but it's also bonds. Okay, so you tax corporations, and corporations borrow money, and that's another way in which capital can flow to firms. So that assumption becomes actually critical. And it turns out that that it's critical because, for a subtle reason, it actually doesn't change a lot in 2016, 18, but the composition of the ownership of bonds and equities has changed over time. And once you twist that assumption, that generates the trend. Now, maybe that's a bad assumption. You know, that corporate tax should fall on all of capital, or should fall on both bonds and equities. You know, I'm open to the discussion, but that's what's behind of all of it. All right. There are other issues about the top that maybe I'll actually skip. So they're a bit more subtle. They don't matter for a big picture. They matter for basically the extent of to which you can sort of tell a story about smooth decline in progressivity versus a lot of other things going on. Capital gains are kind of the biggest part of that. Actually, I should say one thing about Forbes 400. So Forbes 400, so numbers for 2018 are effectively, it's sort of data, sort of guesses. We don't know 2018. We know the aggregate amount of revenue from corporate taxation. That's kind of one key component. The other key component is you have to assume something about income of the Forbes 400. Effectively, you have to take somewhat seriously the numbers that are in the Forbes 400, the estimates of how well Forbes observes wealth. We don't have great estimates. There is a comparison of estate tax returns, basically people from the Forbes 400 list that died. You can look at their estate tax returns. You can see how much wealth is reported there. That's of the order of 50 to 60%, and not 100%. There is a question of what's the difference. Is it evasion? It's probably not all evasion. Forbes is likely to overestimate things for a number of reasons. They don't observe debts. There are well-publicized stories of famous, well-known people who probably have much less wealth than Forbes thinks. There is ownership is often not just the individual; it's the family. So that should be split and so on. So there are issues there. All right. So on measurement, the bottom line is that there are tons of assumptions here. So I wouldn't be willing to do the type of thing that they said that they've done in the New York Times editorial and say, conclusively that it's absurd that that the rich pay lower taxes than the poor. That really requires kind of very particular way of looking at these numbers and kind of ignoring a lot of other evidence and taking all of these assumptions very, very seriously. I've read the book finally yesterday. Until now, I've been reading technical appendices, and it's not a bad book. I highly recommend reading it if you can look past the numbers. There is a lot more there. It's actually interesting. It's well written. And I'll stop with my last slide that will sort of touch on maybe what we'll discuss regarding the reform. So this is just food for thought. If you compare how the US is raising its revenue and how other countries are raising its revenue. Okay? So the US has a smaller government than what's shown here is Canada because it's close, and the average of OECD countries. So the US has a smaller government. You can basically explain almost all of the difference by looking at the value-added tax, the tax that the US doesn't have. Right, so that's really, if the US had a value-added tax that OECD has, it would be basically collecting as much revenue as the average OECD country. And I'll show this one. There's a little blue line on the left at the bottom of United States, and a little red line at the bottom of the OECD average. The blue line for the US is the smallest state tax that the US has, and the red line is, actually there's a little bit of blue there as well. It's a state inheritance and wealth taxes in OECD countries. They're just not there as a source of revenue.
You want a couple of minutes to respond? Yeah, you're like, not really. Or we can take questions. Up to you.
No, very quickly. Thanks so much for the discussion. What we are trying to do in this overall research program is to create distributional national accounts, and so I thought I would say just a few words about kind of what's the broader kind of philosophy and research. So the idea is the statistics that we have today are national account statistics with aggregates only, total GDP, total tax revenue, total government spending, total consumption. And that's what macroeconomists use. And on the other hand, you have lots of studies about inequality that are based on survey data or tax data, but which are not consistent with the macro aggregate, in the sense that the total flow of income in surveys or in tax data is lower than total national income, or the total amount of taxes in those studies, or transfers is lower than total government spending and total taxes. So what we try to do is to have an integrated, combined approach where we take the macro aggregates and combining all the information that exists, we try to distribute these macro aggregates, which makes it possible to do things like, when GDP is growing 3%, here is how much growth there is for each group of the population in a way that's consistent with headline growth numbers. Or, when the tax to GDP ratio is 28%, what's the tax to GDP, what we do in the book, what's the tax to GDP or tax to national income ratio for each group of the population. And let me stress at the outset that this is what me and Emmanuel Saez, Thomas Piketty, and many other researchers in many countries have been doing over the last 5-6 years. But this is a project that's very much in its infancy in many ways, So the methods we have evolve, the data become better, and the point is not to say that we have the perfect, definitive, final series. The point is hopefully that these distributional national accounts and these statistics will be taken over by government agencies and published by government statisticians, which is not the case today. There's no government agency that distributes, GDP or that distributes total tax revenue. CBO is only about federal taxes, for instance. JCT is the same. So that is important because it also helps understand the broader conversation about the methodology. The national accounts themselves rely on a ton of assumptions, and there's a lot of uncertainty, and there's a lot of imputations. The measurement of GDP, what is GDP? If you knew, the hundreds and thousands of assumptions that get in there, you have underreported income, you have imputed rents for homeowners, you have millions of things. And this is constantly improved. The conceptual framework is improved, the data is improved. And this is what we are trying to do. And obviously, we are much less advanced than GDP, and of course, it would be much better if this was done by government agencies than by the World Inequality Lab and a team of academics. But we hope we'll get there. And in the meantime, all the code, all the data are online, and so I very much encourage people to look at it and to say, look, we should do differently here. There are lots of assumptions, clearly, just like for GDP, and there are different ways to do things. But my question for Wojciech would be, what would you do differently? All the choices that we made these choices for good reasons, obviously, that we try to explain and to defend, and I'm not going to go through all of them. And I think, it's always possible to say, there are different ways to do things, and there are assumptions, and there are uncertainties, and, look, even for GDP, that's true. But maybe a more constructive approach is to say, look, that is wrong, you should do like that. And so I'm happy to discuss that. I think we did the best we could. The other thing that can explain, two last points. One is the series are revised all the time because the national accounts themselves are revised all the time. So in particular, in our earlier paper that was published last year, but that was written 3-4 years ago, in the national accounts, the profits made by the Federal Reserve were counted as corporate income taxes. That has changed since then, and so there's now much less corporate income tax revenue. That was kind of a bug in the national accounts, and that explains a lot of the difference in recent years. Our series, incorporate new data all the time, and so by definition, they're always better than the earlier series. So that's one thing. And more broadly speaking, again, I think let's try to improve these. These are not the final series. They will be improved. They will be better in the future. One question that's legitimate is, if you have all those uncertainties, can we really know anything about what's going on? Do we really know that inequality is rising? Do we really know that tax progressivity is falling? And do we really know that the poor pay a lot in taxes compared to the rich? And the answer to these three questions is yes. Inequality is rising. We know this from basically all sources, whether you look at survey data, whether you look at tax data, whether you look at rankings of wealthy individuals, you look at census data. We can debate the magnitude, but I think almost nobody denies that. Do we know that tax progressivity has collapsed? I don't know if I can show a graph very quickly, maybe it's not so important, but if you compare just the evolution of the top 0.1% tax rate, both in our earlier work and in the book, in fact, when you look at the full-time series over a century, there's basically very little difference. There was a huge increase in tax progressivity from 1913 to the Second World War, and then a big decline. I think nobody can say that this has not happened. And what about, are we sure that the poor pay a lot in taxes? The only other estimate of consumption taxes that exists is actually by one think tank that's called the Institute for Tax, ITEP, Institute for Tax and Economic Policy, that finds the same consumption tax rate that we find at the bottom, about 10%. So on the substance, I think there's little doubt about these three things. Whether the series can be improved, of course, they can always be. There's no perfect definitive data series, and tell us how to improve.
Okay, you have 30 seconds.
All right, so I completely agree that all sources of evidence that we have showed that inequality has increased, but the differences in how much it increased are pretty striking, depending on the source. So that's point number one. Point number two is that what I would like to see with these things is not presenting them as facts and acknowledging the extent of uncertainty. That doesn't come up in the book. That doesn't come up in popular presentation of all of these numbers. They are presented as the best available evidence, and we know this is what's been happening. And
but that's the best evidence, frankly. It is the best evidence. And GDP is not a fact either, and there's uncertainty.
these are not facts. Maybe we have to figure out some way of constructing confidence intervals about them around them that correspond to the extent of uncertainty or things like this. When I look at this comparison of Otten and Splinter series and their series, these are big differences, and I looked through these assumptions, and most of these things are just hard to know. So there is huge uncertainty there. That's as an economist, that's not how we do things elsewhere. You estimate things, and you try to be careful about getting precise estimates, and you try to be careful about documenting the extent of uncertainty that you have. I think this is, given the importance of these numbers and visibility of these numbers, like there is no excuse for not doing something along these lines in this context. And it's not a purely statistical exercise because these are imputations. So I'm not 100% sure how to do that. But there are, you can show ranges with the set of assumptions, something like this. But that's I think this is critically important for having a serious conversation about these things.
I would just point to the national accounts again. This is exactly how we do things for economic statistics. Okay. Exactly. GDP is not presented with, look at all the uncertainties and so on. So that's what we're trying to do. And you can say it's a bad project, but that's the reasoning. That's the way it is done in standard economic statistics.
Okay, so let's open it up to some questions from the audience. I mean, I have my questions, but I can ask them later. So, go ahead.
It's right here. So the race to the bottom is always kind of like justified on growth grounds. This is more discussion about incidence. So, what's your general view about these arguments that lower rates, lower tax rates, trigger faster growth, and that the reforms, this is a way of putting the Laffer curve argument, pay for themselves?
The evidence.
None of us will agree with this one.
Yeah, no, the evidence is not very supportive of that view. You look at the Trump tax cut, and federal corporate income tax revenue have declined by 40%, between 2017 and 2018. The broader big picture answer is when it comes to saving and investment decisions, like many other things actually, one of the big results of modern economic research is that tax incentives matter relatively little and matter much less in particular than things like default options, for instance. So if you want to increase overall saving in the economy and so in the end overall investment, you can, for instance, have tax-free retirement accounts and people are going to save more, there's going to be more investment. Or you can have default options where new workers are automatically enrolled in pension plans. And what modern research shows is that default options have like 10 times more impact on the overall saving rate than tax incentives. Tax incentives mostly gives incentives to people to switch from tax exempt to taxable, from taxable to tax exempt accounts, whereas default options increase the overall saving and investment rate. If you look at the very long run, correlation between capital accumulation and capital taxation in general, the US at some point taxed capital a lot, with the 50% effective corporate tax rate plus the high tax rates on dividends, on estates, and so on. That was also a period when overall saving and investment was strong. And since 1980s, since capital taxation has declined a lot, saving and investment also have declined a lot, precisely because there have been these other changes, these regulations that matter so much for saving and investment, like related to pensions or to mortgage debt or the supply of credit, have changed at the same time. So the short answer is there's no good evidence, in my view, that taxes have a dramatic effect on capital accumulation.
I have a mic. Sorry.
Great. Andrea, and then we'll come to that side.
Can you hear me? So you offer a very nice idea for corporate taxation, which is for companies headquartered in the US, we will have like this default minimum tax and they would be responsible for the tax deficit. But what prevents them from moving overseas? And to solve that situation, don't you need true international coordination? And what kind of political things have to happen for that to work out?
Yeah, that's a great question. You're absolutely right that the main kind of limit to what we are proposing is, what about tax inversions and companies are going to move abroad? So several answers. One is manipulating the nationality of a company is actually very hard. So that's regulated by regulations, and so in particular since the Obama administration, there's been a number of change on inversion rules, and you've had 0 inversions since then. The idea is if you've been created as a US company, you cannot, essentially renounce US citizenship for a corporation. That's something that can be controlled, quite strongly by regulations.
But you can be both.
But you can be born abroad, and so then there are two answers. One is if you're incorporated abroad from the get-go, but you have all your sales in the US, in our system you'd be taxed just like a US corporation. It would make no difference because the tax deficit would be a portion proportionally to where sales are made. So if it's a US company that operates in the US, that's headquartered in Bermuda, but in fact its clients are in the US, in our system, that's strictly equivalent. And the last and probably the most important answer is, I totally agree with you that the solution, the most robust solution, is international coordination. And how do we get there? In my view, you get there by putting taxes at the center of free trade agreements, which is saying, look, we're not going to sign any free trade new deals if there's no agreement on minimum country-by-country taxation. And the logic, I think, is very strong. All these free trade agreements these days are about property protection, intellectual property, dispute resolution, settlement. And look, property cannot only comes with rights and no duty, so we should talk about taxes. Now, if you have a US administration that starts saying this, free trade agreements, yes, if that comes with an international agreement on minimum taxes, then I think a lot of progress could be made quite quickly. Just to finish, one illustration is what happened with bank secrecy. And Swiss banks, for a long time said, we will not send information to the IRS and to foreign countries' tax authorities. And in 2010, the Obama administration said, look, you have to send us the data, otherwise you'll face economic sanctions. And all of a sudden, they said yes, and for decades they had said no, we are entitled to our own laws, bank secrecy. But if you make that a priority of international relations, then actually change can happen pretty quickly.
Take a question from this side.
Just occurs to me, unless I'm mistaken, the tax deficit. Don't we handle it exactly like that for individuals? That if they earn income elsewhere, they have to pay the difference here.
Exactly.
So in terms of philosophy and application, you could just say we treat everybody, including corporations, the same.
Exactly correct.
Thanks, and thanks so much to the panelists for participating in this discussion. I feel like I learned a lot, and this exchange was productive. So my question is from the historical account that you present, Professor Zucman, in the book. So you, it seems to me, highlight the really important role that norms played in restricting the sort of tactics that were seen as acceptable now that weren't acceptable in like the 1970s and 1980s. And I wonder how your policies need to fit within a broader change of practices in institutions and culture in order to ensure levels of compliance like those we had in mid-century and before that.
Yeah, that's a great question, and indeed, these things tend to go together. Progressive taxation, at least historically, has also come with, a certain set of norms and belief systems and ideology about, what's the proper role of government in organizing collective action, the need for collective action in the first place, the role of government, the role of democracy. So. You see that, with Franklin Roosevelt, he kept shunning tax dodgers, going to the radio saying how important it was to pay taxes and how tax dodging was bad. And then in 1980, you have the opposite. You have Reagan arrived and said, government is not the solution, government is the problem, and that's when the supply of tax avoidance skyrockets and this whole industry develops. And so how these norms change is a difficult question, but historically they do change. And so I'm relatively hopeful that if there is this demand for progressive taxation, if there is an administration that has a platform that wants to address that demand, it will also come with a kind of change in norms that make progressive taxation actually self-sustainable.
So I'm skeptical about one thing here, and that is the fact that the norms have changed. And I'll give you an example, not from income taxation, but from estate taxation. So I worked on the estate tax, and one of the things that I cite regularly is a paper from 1973. It's published in Columbia Law Review. That's called A Voluntary Tax, and it's a really fun paper because it describes very creative strategies for evading the estate tax, and that's strategies from the 1950s and 1960s. So this notion that people were not doing these things, I just don't believe it.
So yes, thank you so much for both of you. I really appreciate the frank and candid exchange. It's very refreshing. And it is really. But at the same time, I'm a little bit disappointed because I would have loved to see that discussion on the policy aspect, right? So, for example, how much of that difference in data matter for the policy implications, right? So, because at the end of the day, and now I'm going to say something I hope I'm not going to be misunderstood. So at the end of the day, what happens to the bottom doesn't matter at all for the policy, right? You're thinking about taxing. And so okay, so there are maybe you guys are overestimating how much the poor pay in taxes. But at the end of the day, how is this going to be affecting the ability to tax the very rich, right?
Okay, so maybe I'll respond to that. So clearly there was a limited number of things that I was able to say. Specifically on the wealth tax, I highly recommend my comment that will be on their paper in the Brookings papers on economic activity that I'm supposed to finish by the end of this week. So it will be it will be available, so you can learn what I think about the wealth tax. And I think the bottom matters, although I'm not sure these particular numbers matter. But there are a lot of legitimate reasons why the US needs revenue, and it needs to raise revenue. And we can go through the list, but a lot of them have to do with redistributive policies, early childhood education, things of that nature. Also social security crisis that will come sooner than we may think, and so on. So there is revenue, and that's why I put that slide. That's where that's how everybody else is raising revenue. So most of the world doesn't really tax revenue through very progressive taxes. There is progressivity. But the following slides after this one, they show VAT, importance of payroll taxes, importance of excise taxes. Well, income tax and corporate tax are there, but the US is not terribly out of line in terms of how much it collects from income and corporate taxation. So I'm not saying that you shouldn't increase progressivity somewhat, and I have a list of things that should be done. Like high on that list are changes in capital gains taxation, and number one is removing something called step up in basis at death, through which capital gains escape taxation if you don't sell them before you die. That makes no sense. Then various ideas that they have about implementing the wealth tax. Basically, all of them apply to the context of capital gains, because if you can measure wealth, then you can measure capital gains, because you can observe changes, and you can measure them on an accrual basis if you were measuring these things all the time. I don't believe that you can measure all of these things all the time, but we can do much more than is being done right now, and these are sort of ways of taxing much more of capital income as it accrues than is done nowadays. And maybe you can increase rates a little bit as well. But there are various things that you can do as sort of relatively small but from revenue point of view, very consequential changes of the tax system. Looking at 2018 reform, like the most outrageous thing there was not corporate tax. Like the rate was reduced maybe a bit too much because it wasn't revenue neutral. In the end, it was losing revenue. It could have stayed higher. The most outrageous thing there was on the income tax side, and that was a break, that's a new break to pass-through businesses. So basically closely held businesses, 20% discount in their income tax rates. That makes no sense. Like undoing that is like one obvious thing that next administration should do. So there is a lot of revenue that can be raised through things that are not revolutionary.
Can we get a question? I'm also conscious of the gender mix of the people that have spoken, so.
I'm actually going to ask a clarifying question, and I want to specify that I'm not a tax person, so I may simply be misunderstood. So when you all were talking about the changes for people at the top, you all were really focusing in on the corporate tax. I was wondering if there were changes in capital gains that you felt had made a difference as well, or if that was playing a much smaller role. And then obviously interested in your perspective on that as well.
Yes, not much has happened to capital gains taxation in the US. Capital gains have always been taxed at 20-25% with not much variation over time. The two big changes in terms of taxation at the top is, one, there was this period of very high top marginal income tax rate, but these rates were for incomes above several millions of today's dollars. And the main effect of these high top marginal income tax rates was not to collect revenue. They collected little revenue. It was just to compress the income distribution. And that's obvious when you listen to the Roosevelt speech, I want a legal maximum income. Nobody should earn more than $25,000. Everybody understood. That's not going to collect revenue. That's the whole point of this policy. So it never collected a lot. And the other big change is the corporate tax. Corporate tax, as I said, kind of de facto minimum tax on shareholders and the very rich. That one has changed over time enormously.
So I agree with most of it, but I would add another thing that has implications for a lot of these measurement issues and basically how you should be thinking about the top of the distribution nowadays. And that is that until 1986, if you had a closely held business, it was in a corporate form. It was retaining earnings. Like the name of the game was not to pay out income because the rates were too high. After '86, the incentives changed, and basically what happened since then is that businesses, not big businesses, not like Google or Intel or businesses like this, but businesses that are worth tens of millions of dollars that don't have a lot of owners, partnerships as corporations. They are taxed not through the corporate income tax, but they are taxed through the individual income tax. So basically, what happens is that firm has profits, and that's reported as the income of individual shareholders. So that had a number of consequences. So one consequence is that we see much more of that income in the ways that we couldn't see that before. So I think that's actually understudied question in terms of these longer term trends, and beyond that, the rates. Like there are basically new, different types of avoidance strategies that you can play on the individual side. Like the main things there that are happening. They are non-trivial, but not like 20 percentage points. They are about like cheating on payroll tax, reporting what should be compensation as capital income, things of that nature.
Okay, I think we have time for maybe one short question. Go.
Hi, I'm a freshman at the Kennedy School, and Jeff Liebman in the Honors Microsequence teaches that the TRA 1986 law was distributionally neutral because tax expenditures were also non-progressive. And I'm just wondering if we have to send an email to Jeff to say change syllabus, or what
like what has changed about the story from 1986? Like I think it was Feldstein's thread of literature from there, but I'm just curious about how to think about that stylized fact.
I agree with Jeff. It was distributionally neutral. It was designed to be distributionally neutral. It had a lot of consequences because it changed marginal tax rates. It had consequences. It definitely had big consequences around the time of the reform, like within the year before, the year after, capital gains realizations, and so on. It had enormous consequence that relates to what I've just described: this conversion of businesses from corporate form to various pass-through forms. There's I think million businesses that sort of converted almost overnight. So it had consequences, but if you look at just general tax burden, on the impact, that particular reform didn't have enormous consequences.
Yeah, no, I agree with that. You look at our series, and it's not like there's a huge decline in tax progressivity in '86, but you have to understand the reason why is the bad stuff happened before, between 81 and 86. So between 81 and 86, you see a big decline because you see a huge increase in tax sheltering, where people start, there is this whole industry that starts selling tax shelters, investments in partnerships that make losses for the sole purpose of allowing people to deduct losses from their income. And these booms, in between 81 and 86, the net partnership income that's reported in the US by all US taxpayers is negative. It's like the entire, partnership sector is making losses, and that's something that was encouraged both by the change in norms, the Reagan, government is not the solution, government is the problem, and also a number of changes that happened in the first Reagan tax reform of 81, where he gives more generous depreciation allowances for all sorts of businesses in mining, in real estate and so on, making the tax shelters even more powerful. And that's this process of erosion of progressivity between 81 and 86 that paved the way for the 86 tax reform. At least that's the story that's our reading of the evidence and the story we tell in chapter 3 in the book.
Okay, I think that's a good note to cap it on. Thank you all for coming. As I said, this book's available outside for people to look at. I was hoping to be talking about the wealth tax. Yeah, there was only so much to say about it.